So, hey guys, so chapter 4 in the Redbook, so this is the 11th edition. So, for those accounting 3 kids, you guys, this is a pretty long chapter. So, this is why we're going to do this chapter over a couple of weeks. So, it talks about all of the end of the period stuff, the stuff that we have to do to make sure that we're ready for the next year. So, I'm going to go ahead and zip me off here and we can watch and we can go through this slideshow. So the first thing that we have to do is make sure everything is accurate. So we want to make sure that our financial statements are accurate because all of this information, because this is for a corporation, has to be submitted to the SEC. So it's the Securities and Exchange Commission. So we want to make sure that all of it, after it gets disseminated to them, then it gets disseminated to all of our stockholders. So we want to make sure that we're in the best possible financial health that we can be. And um, so our reporting, our accounting period could be 1 month, 3 months, 6 months, the whole year. So we talked about this in the very, very beginning of Accounting 1, what's called that fiscal period. And so it just depends on the business of what that fiscal period is. And so at the end of the fiscal period, you'll be doing the financial statement. So whether it's every month, every 3 months, every 6 months, every year, it just depends. So the fiscal period or the fiscal year, though, is 12 consecutive months. So it could run from March to February. It could run July to June. It doesn't matter as long as it's 12 consecutive months. So we just have to make sure that everything is done. So all the journal entries have been made, everything has been posted, everything is up to date before we get ready to do our endings, before we get to do our ending stuff like our worksheet and all that good stuff. So the schedule of accounts receivable and payable, that's just a list. It's not anything new that you guys have seen. It's something that you guys have already done. So this is just what it looks like. Our who, what, and when is at the top. And then it just has a list of all of our customers on there and then how much total we have. And then remember, this total is compared to what we have in our accounts receivable and our general ledger to make sure that that number is accurate. So the bank statement, reconciling the bank statement, we have done. This is kind of like the mini version right here, right? The bank statement balance, deposits, outstanding deposits and checks. And then we have our checkbook balance, any kind of charges. There looks like there was a posting error of $9, and so then we have our adjusted, and those two have to equal. So you have once the general ledger is done, then you do your trial balance, and that we're doing just to double check to make sure that our debits equal our credits. And so that's typically called the unadjusted trial balance. Once we have done our adjustments, then we do an adjusted trial balance. So this is just to look at what an unadjusted trial balance looks like. Notice the white because it's going to be super long. And then once we have, then they're going to provide us our information for our adjustments. And then all of those adjusting entries have to be made. So my suggestion is go ahead and either use your book or use this for your adjusting entries so you know what accounts to use. Once you do your inventory, notice you have both grills and furniture. You'll have to do because we're doing the dual. So you'll have to do an adjusting entry for both inventories. Okay. And notice it went into income summary, guys, just so you guys can see that. Went into income summary. And then we have our supplies expense and supplies, insurance expense and prepaid insurance, and then we have our depreciation. So the depreciation numbers are usually given to us which is what we like. We don't have to calculate it, and they're fairly straightforward. The other ones we have to do some very basic adding or subtracting. So after those adjustments are made, we have to figure out our income. So we have to take our income statement accounts. Those are our income summary all the way down to our expenses. Those are our income statements. The income statement credit column, the income statement debit column are our expenses. We subtract those two, and that will give us our preliminary income before taxes. And then we use that number to calculate our income tax based on the graph that's in the book. So we will have already paid some. The difference is our adjustment, and then that's what we'll put in our adjusting entry for that one. Once all those adjustments are made, we do a new trial balance with all of the updated balances in there, and we still have to make sure that our debits equal our credits. All right. So it says, so assigning control of revenue, costs, and expenses to a specific manager is called responsibility accounting. So we want to make sure that the information that we're getting for these areas are coming from somebody that's in charge of these areas. You don't want somebody in charge of accounts receivable doing all of the revenue. So we want to make sure that we have those people that are in direct charge of those accounts to be in charge of those areas. So it says an operating expense identifiable with and chargeable to operation of a specific department is called a direct expense. And then an operation expense chargeable to overall business. So like overall business would be like utilities or the rent. Those would be overall. But if we had something like advertising to grills, those would be a direct expense. I hope that makes sense. So if it's indirect, that means it will cover the whole business, like rent, utilities, phone, that kind of thing. And then direct would be something that is specific to one of our 2 ways to earn income. So we're going to be doing those departmental margin statements to see how we're doing in each of the departments. And so this is what that looks like. And you guys have done this earlier in accounting too. So this should be kind of a little bit of a refresher in accounting 3, because accounting 2 is doing this right now in chapter 22. So it's basically just format. So they've given us all the numbers and we just have to plug those in, and then we calculate our percents. So remember, the number here, our cost of merchandise sold, will be divided by the net sales. And that's how we get our percentages. So there are a couple of financial ratios that companies look at. And so they have, and then they look at also that vertical analysis that we just talked about. So one of these is that departmental margins. They want to see how much each department is making compared to the net sales. So then they can look and say, okay, this department is making 25.9% of all the net sales. Oops. So they give us a range. So they have what our prior year was, what our target range is. And so we kind of want to hit inside those ranges. And you look at our cost of merchandise sold went down from the prior year, which is good. That's a good thing, right? Because that's the cost of us. That's the cost to us of the merchandise that we're selling. Our gross profit on here went up from the previous year, which is right in the middle of where our target range is. our direct expenses, those are the expenses directly related to the selling of the individual items. Our direct expenses went up, so they're a little bit over our target range for the current year. And then our departmental margin went up. So, you kind of see it's a little bit, it went up by 0.4 here, and so did the departmental margin went up by 0.4. So we just look at those numbers and we compare them to the previous years, just kind of see how we're doing. So here's the income statement. So all of this, so the information is given to us pretty much in the book. We're just plugging the numbers in. So they give us our net sales for we take, some of this information from the departmental margin, right? So this is the information for the departmental margin statements. This down here underneath is our indirect expenses. That's from the adjusted trial balance. And then we have our information from our income taxes. So all of this information is basically given to us. We're just plugging it in and then doing our vertical analysis. So that's the income statement. The stockholders' equity looks very similar to what it did before. So the income statement looks a little bit different, right? Just because it's broken up into departments. But this looks very similar. So here's our capital stock, here's our retained earnings, and then our total stockholders' equity. And over here, it tells you where that information came from. All right. So you know where you can get it. And then we have our balance sheet. That balance sheet is one of the last things that we have to do before we post all of our adjusting entries and do our post-closing trial balance and do our closing entries. So this just double checks to make sure that our assets are equaling our liabilities and our owner's equity. So notice our assets are on the top, our liabilities and owner's equity are on the bottom, and those two numbers should equal. And of course, in this example, they're going to give us one that equals. So we have a cash flow statement. You guys have already done one of these. It has the three pieces: operating, investing, and financing. So anytime we have a payment, just a reminder, it's going to be negative. So that's what the brackets are. They're negative. It just symbolizes the negative numbers. And notice these two numbers here that we have are subtracted to get this one. These two numbers, we're going to end up with a negative number because one is positive and the larger one is negative. Same thing here. And then we are going to be subtracting those numbers. So what this does is that it keeps track of what we should have in our cash over the period of over the year. Okay. So this is just another way for us to check that cash proof, basically. So the last part of the closing is the closing entries. So they've already done the adjusting entries, the closing entries. So there's still only 4 parts to the closing entries. So we're going to close all those sales and purchases into income summary. Then we're going to close all of our expenses into income summary. And then we're going to close income summary into retained earnings. And then we double check to make sure, look, same number, same number. We double check to make sure that our numbers match. And then we close dividends into retained earnings. So the only thing that's open after our closing entries are just our permanent accounts, our assets, liabilities, and just those few owner's equities like capital stock, retained earnings. So this is what that post-closing trial balance looks like. So it's really short compared to the adjusted trial balance because it only has those permanent accounts. And then we still have to double check to make sure that our accounts equal before we're ready to go on for the next year. So this is all preparing for that next year. So once that's done, the accounting cycle then has been complete. All right, so it's gone through all 12 steps on here. In accounting 2, I just did this thing with chapter 22. There's 13 steps on there. I don't know why it changes, but this is the way this is how they are doing it for the Red Book. All right. So those are the steps. So journalize from our transactions to journalizing, posting, doing our this step 5 and 6 would be our worksheet basically. 7 is getting everything updated into our ledger to do our financial statements. Then from our financial statements, we'll do our closing entries, we'll post them, and do our post-closing trial balance. All right, guys, so that is what we're going to be doing in chapter 4. Like I said, that's why it's super duper long. So we'll just take it one step at a time as we go, and we'll go from there. Have a great week.